Welcome to Subramani. So, what are the mistakes that investors should avoid at this point in time? One, when you watch too much television or YouTube videos and you read too much, you get confused about what is happening in the market. So, very good chance that you will be itching for action, saying, I need to do something. Subra also said, sell overvalued shares and buy undervalued shares. If you can't do that, stick to BAF or stick to your equity asset allocation, your asset allocation, how much you put in equity, how much you put in debt, and how much you put in gold. However, I have another problem. If you look at BAF and decide how much to put in debt and equity, you have to make an assumption that that fund manager gets it right always. Because if he gets it wrong and you get it wrong, then you're going to kick yourself for having listened to that fund manager. So decide on which fund manager to listen to. I have no personal favorites. I'm not naming anybody. Or if you think you know my personal favorite, then go by that. I'm not getting into recommending any such thing. So be careful about with whom you are talking as to what parts are overvalued, and check out on that. The other thing which many investors do is go to extremes of saying, I sold off everything, I repaid all my loans, and I put all the money in PPF or stuff like that. Well, that is really difficult. But don't do this all or none thing, because none of us know whether the market is already hit its peak or it's about to hit its peak. But be sure about one thing: if you have bought something and that has worked for you, don't expect the same thing to work for you permanently, right? You bought something in March 2020, that share has doubled or tripled, or you bought it for 50 rupees, it is now worth 300 rupees, so it has gone up 6 times. Now it can't go up from 300 to 1800 6 times. Now take a fresh look at 300. Is the share worth buying? Is the share worth keeping? Would you buy it today if it was available at 300? Or are you being hit by a bias saying, oh, this company has been so good to me, so I will stick to it? See what is are you being biased, or are you being fair, or are you being judgmental? Are you being clear that you want it in your portfolio even today at 300? If the answer is yes, keep it. If the answer is no, then realize that what you're doing is right. Sell it off. Fine, you got 1000 shares. It doesn't mean you need to sell off the whole 1000 shares. Sell off 500 shares, right? That will at least ensure that a lot of the profit has been booked. Your 500 shares which are lying is something which it's great, it's got good value, but it will not kill you that if the price goes down, because you think you already recovered it in these 500 shares, right? So do all those things. Does not mean you have to do an all or none thing. And when you listen to a professional, or you watch a professional, or you watch 2-3 professionals, maybe averaging makes sense. Or if you're very confident about one professional, look at just his BAF portfolio. Don't look at too many BAF portfolios. Today there are at least 42 BAF portfolios. I'm expecting another 42 to come, because there will be a BAF value and BAF growth. All these things will happen. So find out that how much is the noise and how much you want to really listen to the market. Both are very important. Also understand that performance chasing always happens, and therefore we will look at past performance and say, look at the CAGR, it is so high. But CAGR is high because last 1 year was high, because your 1 year, 3 year, 5 year, 7 year, all of them have your 1 year data. So that to that extent, all this data is being skewed, all the results are being skewed. So be careful about that too, right? Thank you. Having said what an investor should do, I think I should also cover what an investor should not do. What an investor should not do is panic and sell all the equity and get into debt. No, that does not make sense unless you need the money immediately. You would have been very lucky if you are retiring now and you have all the money available to invest, because the market is at this stage. If you had got the money in, say, December 2019 or maybe October 2019, and you had invested all your money in equity, chances are in March you would have panicked. If you did not remove the money in March, congratulations, that's a great thing to do. If you should have put more money, but the fact that you did not remove that itself is great, because For a retiree, there is something called sequence of return risk. So as soon as you retire and you have a lump sum, and if you put it into equity and the market tanks 20% or 50% or 70%, you will panic. It's bound to happen, and the fall is so dramatic that a 50% fall can be made up only with 100% rise in market. You put 1 crore, it became 50 lakhs. It has for it to become 1 crore, it has to double. It has to get 100% return. So it would have been very difficult. So if you did not have such an aggressive stance and you had a lot of money in debt and cash, it would have been a great time for you to buy in March, April, May, June, even in a staggered way, and you would have still made a lot of money. But I do not know whether you did anything of that sort. The question is, what should you do today if you are a retiree, or what should you do if you are 2 years away from retirement? I would still be very conservative. Not because I think that anything has happened in the market, but simply because last 6-7 months, the large number of new traders have come in. Now these are people who may just be going to Google and seeing which are the best Indian shares to buy, and pops up Asian Paints, so they go and buy Asian Paints, right? We have seen this happen in the past. So it's not that Asian Paints is a bad company, but the PE may be wrong. It's not that ITC is a bad company, but over the last 5 years the return would be 1% or 2%, right? It is not recovered from that huge ETF selling which the government did. So it has just not recovered. Yes, it's a good company, it's throwing up a lot of cash. I don't have it in my portfolio, but you be careful about what you are doing. So check your portfolio. If you're not very far away from retirement, you will have to be very conservative, because this market is a little risky and a little dicey, because there are just too many factors at play. Put a little money into equity. SIP always makes sense, and if you are a little worried about the market, put the money in a liquid fund and do an SGP. All that is fine, but entering the market today for a retiree with this huge sequencing risk is not advisable. I would think you should be a little more careful about how you are handling your money. Sequence of return risk will hit, because next year it could be bad in the equity markets. Thank you.